Question 1. Strategic planning requires a registered principal of a California-based broker-dealer to consider the potential civil penalties for controlling persons if supervised individuals engage in illegal insider trading. Which of the following approaches best aligns with regulatory expectations and ethical responsibilities for mitigating such risks? Option A. Delegate all insider trading supervision to a designated compliance officer with minimal direct oversight or involvement from the principal regarding the system's operational effectiveness. Option B. Implement a reactive strategy where potential insider trading is only investigated after a tip is received or a regulatory inquiry is initiated. Option C. Assume that all supervised persons are knowledgeable about insider trading regulations and will adhere to ethical conduct without explicit firm-wide policies or active monitoring. Option D. Proactively develop, implement, and rigorously enforce a comprehensive written supervisory system that includes regular training on insider trading, clear policies for handling material non-public information, and robust trading activity monitoring. The correct answer is D. Proactively develop, implement, and rigorously enforce a comprehensive written supervisory system that includes regular training on insider trading, clear policies for handling material non-public information, and robust trading activity monitoring. Explanation. This scenario presents a significant professional challenge for a registered principal of a broker-dealer in California. The challenge lies in balancing the firm's operational efficiency and client service with the paramount responsibility of preventing and detecting illegal insider trading, which carries severe civil penalties for controlling persons under the Securities Exchange Act of 1934 and California state securities laws. The principal must exercise diligent oversight to avoid vicarious liability. The best approach involves proactively implementing and rigorously enforcing a comprehensive written supervisory system designed to detect and prevent insider trading. This includes regular training for all supervised persons on insider trading policies, clear guidelines on the handling of material non-public information, and robust monitoring mechanisms for trading activity. This approach is correct because it directly addresses the regulatory requirement for broker-dealers to establish, maintain, and enforce adequate supervisory procedures. Securities and Exchange Commission (SEC) and the Financial Industry Regulatory Authority (FINRA), which oversees broker-dealers in California, emphasize a proactive and preventative stance. California's corporate securities law also imposes liability on controlling persons who knew or should have known of the controlled person's violation and failed to take appropriate steps to prevent it. This approach demonstrates a commitment to compliance and risk management, thereby mitigating the risk of civil penalties for controlling persons. An incorrect approach would be to rely solely on the assumption that supervised persons are aware of insider trading laws and will act ethically. This fails to meet the supervisory obligations mandated by regulators. Without a documented system and active enforcement, the firm cannot demonstrate that it took reasonable steps to prevent violations, leaving controlling persons exposed to significant penalties. Another incorrect approach is to only investigate potential insider trading after a tip or a regulatory inquiry. This reactive stance is insufficient. Supervisory systems must be designed to identify red flags and potential violations before they escalate. Waiting for a complaint or investigation means the firm has already failed in its duty of proactive supervision, increasing the likelihood of civil penalties for controlling persons. Finally, an incorrect approach is to delegate all supervisory responsibilities related to insider trading to a single compliance officer without providing adequate resources or ensuring the principal's active involvement in overseeing the effectiveness of the system. While a compliance officer is crucial, the ultimate responsibility for supervision rests with the firm's principals. A principal must ensure the system is functioning effectively and that all supervised persons are adhering to it. Professionals should adopt a decision-making framework that prioritizes a robust, documented, and actively enforced supervisory system. This involves understanding the specific regulatory obligations, assessing the firm's unique risks, implementing tailored policies and procedures, providing ongoing training, and conducting regular reviews to ensure the system's effectiveness. The focus should always be on prevention and early detection, rather than remediation after a violation has occurred. Question 2. System analysis indicates that a registered representative in Ontario, Canada, has been approached by a client who wishes to sell a significant quantity of bearer bonds that the client claims were inherited. The representative notes that the bonds appear to be older, and the client seems unusually anxious about completing the transaction quickly and discreetly. What is the most appropriate course of action for the representative to take? Option A. Contact the issuing company of the bearer bonds directly to confirm their validity before proceeding with the client's request. Option B. Delay the decision and wait to see if the client becomes more agitated before taking any action regarding the transaction. Option C. Proceed with the transaction as requested by the client, assuming the client is acting in good faith and the bonds are legitimate. Option D. Immediately escalate the situation to the firm's compliance department and refrain from processing the transaction until its legitimacy can be thoroughly verified. The correct answer is D. Immediately escalate the situation to the firm's compliance department and refrain from processing the transaction until its legitimacy can be thoroughly verified. Explanation. Scenario analysis. This scenario presents a significant professional challenge for a registered representative in Ontario, Canada, due to the inherent risks associated with handling potentially stolen securities. The representative must navigate the complex interplay of regulatory obligations, ethical duties, and the potential for financial loss or complicity in illegal activities. Failure to act appropriately can lead to severe regulatory sanctions, reputational damage, and legal repercussions. The core challenge lies in balancing the client's instructions with the firm's and the representative's responsibility to prevent the facilitation of fraudulent or illegal transactions. Correct approach analysis. The best professional practice involves immediately escalating the situation to the firm's compliance department and refusing to process the transaction until the authenticity and legitimacy of the securities can be verified. This approach is correct because it aligns with the regulatory framework in Ontario, specifically the requirements under securities legislation and the rules of the Investment Industry Regulatory Organization of Canada, IIROC. Firms and their registered representatives have a duty to know their client and to ensure that transactions are legitimate and do not involve proceeds of crime or stolen assets. By escalating to compliance, the representative is fulfilling their obligation to report suspicious activity and allowing the firm's designated personnel to conduct the necessary due diligence. This proactive measure protects the firm, the representative, and the integrity of the financial markets. It demonstrates a commitment to ethical conduct and adherence to regulatory mandates designed to prevent financial crime. Incorrect approaches analysis. Proceeding with the transaction without further inquiry, assuming the client is acting in good faith, is professionally unacceptable. This approach fails to acknowledge the red flags presented by the client's unusual request and the potential for the securities to be stolen. Directly contravenes the principles of due diligence and the obligation to report suspicious transactions, potentially making the representative and the firm complicit in a fraudulent scheme. Contacting the issuing company directly to inquire about the security's validity without involving the firm's compliance department is also professionally unsound. While the intention might be to verify, this bypasses the established internal procedures for handling such matters. Compliance departments are equipped with the expertise and resources to investigate suspicious activities, and unilateral action by a representative can create operational risks and potentially interfere with a broader investigation. Delaying the decision and waiting to see if the client becomes agitated before taking action is ethically and regulatorily deficient. This passive approach allows a potentially illicit transaction to proceed unchecked for a period, increasing the risk of harm. Professional judgment requires prompt action when suspicious circumstances arise, not a reactive stance based on client temperament. Professional reasoning. Professionals in Ontario should adopt a risk-based approach when encountering unusual client requests or potentially problematic transactions. The decision-making framework should prioritize regulatory compliance and ethical conduct. When faced with a situation involving potentially stolen securities, the immediate steps should be: 1. Recognize the red flags, e.g., unusual nature of the securities client's demeanor, lack of clear provenance. 2. Halt the transaction. 3. Escalate immediately to the firm's compliance department, providing all relevant details. 4. Follow the firm's established procedures for investigation and reporting. This systematic approach ensures that regulatory obligations are met, ethical standards are upheld, and the firm's and the representative's integrity are protected. Question 3. Risk assessment procedures indicate that an introducing broker-dealer registered in California is facing an unexpected operational challenge that will prevent it from completing its Focus Part I and Part IIA reports by the standard filing deadline. What is the most appropriate and compliant course of action to address this situation? Option A. Inform FINRA of the impending delay via a phone call on the due date, and then file the reports as soon as they are completed. Option B. Submit a formal written request for an extension of time to file the focus reports through FINRA-designated electronic filing system prior to the original due date. Option C. File the completed focus reports 2 days after the original due date, as the delay is minor and the reports will be submitted shortly thereafter. Option D. Email the completed focus reports directly to the FINRA examiner, who typically oversees the firm's filings, explaining the delay. The correct answer is B. Submit a formal written request for an extension of time to file the focus reports through FINRA-designated electronic filing system prior to the original due date. Explanation. Scenario analysis. This scenario presents a common challenge for introducing broker-dealers (IBD) in California regarding their financial and operational reporting obligations. The critical element is understanding the precise timing and acceptable methods for filing focus reports, especially when dealing with potential delays or unexpected events. Failure to adhere to these requirements can lead to regulatory scrutiny, fines, and reputational damage. The professional challenge lies in proactively identifying potential filing issues and implementing compliant solutions within the strict deadlines set by the Financial Industry Regulatory Authority, FINRA, and the Securities and Exchange Commission, SEC. Correct approach analysis. The best professional practice involves proactively identifying the need for an extension and submitting a formal request to FINRA through the appropriate electronic system well in advance of the filing deadline. This approach demonstrates diligence and a commitment to regulatory compliance. FINRA Rule 17a-5, under the Securities Exchange Act of 1934, as interpreted and enforced by FINRA, mandates timely filing of focus reports. While FINRA may grant extensions under specific circumstances, these must be formally requested and approved. Submitting the report late without prior authorization or attempting to file it through an informal channel violates these rules. Incorrect approaches analysis. Submitting the focus report 2 days after the due date without any prior communication or request for an extension is a direct violation of the filing deadline. This demonstrates a lack of proactive compliance and in disregard for regulatory timelines. Attempting to file the report via email to a FINRA examiner rather than through the designated electronic filing system is an improper method of submission. FINRA has specific procedures for electronic filing, and informal methods are not considered valid. Informing FINRA of the delay via a phone call on the due date, but not submitting the report or a formal extension request, is insufficient. While communication is important, it does not substitute for the actual filing or a formal request for an extension, which must be in writing and submitted through the approved channels. Professional reasoning. Professionals must prioritize understanding and adhering to regulatory filing deadlines. This involves establishing robust internal processes for tracking these deadlines and implementing contingency plans for potential delays. When faced with a situation that might lead to a late filing, the immediate step should be to consult the relevant regulations, FINRA Rule 17a-5, and FINRA guidance on extensions. The decision-making process should always favor proactive communication and formal, documented requests for any deviations from standard procedures. This ensures transparency with regulators and minimizes the risk of noncompliance. Question 4. The risk matrix shows a proposed acquisition of 30% of the voting shares of a registered broker-dealer in Ontario, Canada, by an existing minority shareholder, which would increase their total ownership to 45%. The broker-dealer's compliance department is debating the necessity of filing a Form 1017 application with the Ontario Securities Commission. Which of the following actions represents the most appropriate and compliant response? Option A. Advise the acquiring shareholder that no regulatory filing is necessary because the transaction does not involve a complete takeover of the firm. Option B. Immediately file a Form 1017 application with the Ontario Securities Commission, detailing the proposed share acquisition and seeking approval prior to its completion. Option C. Proceed with the share acquisition without filing a Form 1017 application, as the acquiring shareholder will still not hold a majority of the voting shares. Option D. Inform the Ontario Securities Commission of the proposed share acquisition after it has been completed, providing details of the change in ownership. Correct answer is B. Immediately file a Form 1017 application with the Ontario Securities Commission, detailing the proposed share acquisition and seeking approval prior to its completion. Explanation: the risk matrix shows a potential shift in control for a registered broker-dealer in Ontario, Canada, which triggers specific regulatory obligations under the Ontario Securities Commission (OSC) framework. The professional challenge lies in accurately identifying the nature of the change and ensuring timely and complete disclosure to the regulator. Misinterpreting the scope of a change or delaying notification can lead to significant regulatory penalties, operational disruptions, and reputational damage. The correct approach involves a thorough assessment of the proposed transaction to determine if it constitutes a change in ownership, control, or business operations, as defined by OSC Rule 1017. If the transaction meets this definition, the firm must file a Form 1017 application with the OSC well in advance of the proposed closing date. This proactive and compliant filing demonstrates adherence to regulatory requirements and allows the OSC sufficient time to review the application and approve the change. This approach is correct because it directly aligns with the OSC's mandate to oversee and regulate registered firms to protect investors and maintain market integrity. Timely and accurate reporting is a cornerstone of this regulatory oversight. An incorrect approach would be to assume that any change in shareholding, regardless of the percentage or its impact on effective control, does not require a Form 1017 filing. This failure to understand the nuances of control under OSC rules could lead to noncompliance. Another incorrect approach would be to proceed with the transaction without waiting for OSC approval, even after filing the application. This demonstrates a disregard for the regulatory process and the OSC's authority, potentially resulting in severe sanctions. Finally, attempting to circumvent the filing requirement by structuring the transaction in a way that superficially avoids triggering the rule, while still effectively changing control, is ethically unsound and a clear violation of regulatory intent. Professionals should adopt a decision-making framework that prioritizes understanding the specific definitions and requirements of OSC Rule 1017. This involves consulting with legal and compliance experts to analyze the nature of any proposed transaction. The framework should include a step for proactively identifying potential triggers for a Form 1017 filing, followed by a commitment to timely and accurate submission of all required documentation, and seeking regulatory approval before implementing the change. Question 5. Market research demonstrates that a client in Ontario, Canada, has approached their registered representative expressing interest in an investment opportunity with a private company. The client states that they have received information directly from the company, which claims the offering is a private placement, and therefore exempt from the usual prospectus requirements. The client is eager to proceed, believing the company is well established and the investment is a good opportunity. The representative has no prior knowledge of this company or its securities. What is the most appropriate course of action for the representative? Option A. Immediately cease any discussion or facilitation of the investment and report the situation to the compliance department of their registered dealer firm for review and guidance. Option B. Inform the client that they should seek independent legal advice regarding the investment before the representative takes any further action. Option C. Advise the client that since the company is well established, it is likely exempt from prospectus requirements and suggest the client seek their own legal counsel. Option D. Proceed with facilitating the investment, relying on the client's assurance that it is a private placement and the company is well established. The correct answer is A. Immediately cease any discussion or facilitation of the investment and report the situation to the compliance department of their registered dealer firm for review and guidance. Explanation: scenario analysis. This scenario presents a common challenge for a registered representative in Ontario, Canada, involving the potential for an unregistered security to be offered. The core difficulty lies in balancing the desire to facilitate a client's investment opportunity with the stringent regulatory obligations designed to protect investors and maintain market integrity. A failure to correctly identify and act upon the unregistered nature of the security can lead to severe consequences for both the representative and the client, including regulatory sanctions, financial penalties, and reputational damage. The representative must exercise careful judgment to navigate this situation in compliance with Ontario securities law. Correct approach analysis. The best professional practice involves immediately ceasing any discussion or facilitation of the investment and reporting the situation to the compliance department of their registered dealer firm. This approach is correct because it prioritizes investor protection and adherence to regulatory requirements. Under Ontario securities law, specifically the Securities Act, Ontario, and National Instrument 45-106 prospectus exemptions, securities generally must be offered under a prospectus or a valid exemption. Offering an unregistered security without a valid exemption is a serious violation. By escalating the matter internally, the representative ensures that the firm's compliance officers, who are equipped to assess the situation against the complex rules of prospectus exemptions, can take appropriate action. This proactive step demonstrates a commitment to regulatory compliance and investor safety, fulfilling the representative's duty of care and their obligations as a registrant. Incorrect approaches analysis. Proceeding with the investment based on the client's assurance that it is a private placement, without verifying the specific exemption and ensuring all conditions are met, is a significant regulatory failure. This approach ignores the onus on the registrant to ensure compliance and assumes the client's understanding of complex securities law is sufficient, which is rarely the case. It exposes the representative and the firm to potential liability for trading in unregistered securities. Accepting the client's word that the issuer is well established and therefore exempt from prospectus requirements is also a critical error. Regulatory exemptions are based on specific criteria related to the issuer, the security, or the type of investor, not solely on the perceived reputation or size of the issuer. This approach bypasses the necessary due diligence required by securities regulators. Suggesting the client seek legal advice without also reporting the potential unregistered offering to their firm's compliance department is insufficient. While legal advice may be part of a comprehensive solution, the primary responsibility of a registered representative is to operate within the regulatory framework and to alert their firm to potential violations. Failing to do so, even while advising the client to seek legal counsel, leaves the representative and their firm exposed to regulatory scrutiny. Professional reasoning. Professionals in this situation should employ a decision-making framework that prioritizes regulatory compliance and investor protection. This involves 1. Recognizing potential red flags. Any mention of private placements, unregistered securities, or unusual investment opportunities should trigger a heightened sense of caution. 2. Understanding fundamental regulatory principles. Recall that securities generally require a prospectus unless a specific exemption applies, and the burden of proof for an exemption lies with the party claiming it. 3. Internal escalation. Immediately consult with the firm's compliance department. This is the most critical step, as they possess the expertise to navigate the nuances of prospectus exemptions and regulatory reporting. 4. Documentation. Maintain thorough records of all communications and actions taken. 5. Client communication. While awaiting guidance from compliance, inform the client that the matter requires internal review due to regulatory considerations, without making definitive statements about the investment's legality. Question 6. Governance review demonstrates that a California-registered broker-dealer may have underpaid its SIP general assessment for the previous fiscal year due to an error in calculating its net operating revenue. Which of the following actions best upholds the firm's regulatory obligations? Option A. Wait for SIP to initiate an inquiry before addressing the potential underpayment. Option B. Immediately amend the SIP 6 general assessment payment form, remit the underpaid amount along with any applicable interest or penalties, and notify SIP of the correction. Option C. Disregard the potential underpayment, assuming SIP will not detect a minor discrepancy. Option D. Adjust the current year's assessment to compensate for the previous year's underpayment. The correct answer is B. Immediately amend the SIP 6 general assessment payment form, remit the underpaid amount along with any applicable interest or penalties, and notify SIP of the correction. Explanation. Governance review demonstrates a potential lapse in compliance regarding SIP-6 General Assessment Payment Form submissions for a broker-dealer registered in California. This scenario is professionally challenging because it requires a thorough understanding of SIP assessment obligations, the specific filing requirements, and the potential consequences of noncompliance, all within the context of California's regulatory environment. The firm's financial and operations principal, FinOp, must ensure accurate and timely reporting to avoid penalties and maintain the firm's standing with SIP and regulatory bodies. The best professional practice involves proactively identifying and rectifying any discrepancies in the SIP-6 filing process. This includes a comprehensive review of the firm's financial records that form the basis of the assessment calculation, cross-referencing these with the submitted SIP-6 form, and ensuring that the payment is made by the established deadline. If an error is discovered, the correct approach is to immediately amend the filing and remit any underpaid amount, along with any applicable interest or penalties, to SIP. This demonstrates a commitment to regulatory adherence and transparency, mitigating potential disciplinary actions. An incorrect approach would be to ignore the identified discrepancy, hoping it goes unnoticed. This failure to address a known compliance issue violates the fundamental principles of regulatory oversight and fiduciary duty. It exposes the firm to significant penalties, potential disciplinary proceedings by SIP and the SEC, and reputational damage. Another incorrect approach is to assume that a minor underpayment is inconsequential and not worth correcting. SIP assessments are mandatory, and any deviation from the correct amount, regardless of size, constitutes a violation. Regulatory framework requires accurate reporting and payment of the full assessment. A further incorrect approach is to delay the correction of the error until prompted by SIP. While cooperation with regulators is important, proactive self-reporting and correction of errors are always preferred and often result in less severe consequences. Waiting for an inquiry suggests a lack of internal controls and a reactive rather than a preventative compliance posture. Professionals should adopt a decision-making framework that prioritizes proactive compliance and robust internal controls. This involves regular internal audits of regulatory filings, thorough training for staff on SIP obligations, and a clear process for identifying and rectifying errors promptly. When a discrepancy is found, the immediate step should be to assess the nature and impact of the error, consult relevant regulations, and implement corrective actions with full transparency to the relevant regulatory bodies. Question: Governance review demonstrates that a California-registered broker-dealer may have underpaid its SIP general assessment for the previous fiscal year due to an error in calculating its net operating revenue. Which of the following actions best upholds the firm's regulatory obligations? Options: A. Immediately amend the SIP-6 General Assessment Payment Form, remit the underpaid amount along with any applicable interest or penalties, and notify SIP of the correction. B. Disregard the potential underpayment, assuming SIP will not detect a minor discrepancy. C. Wait for SIP to initiate an inquiry before addressing the potential underpayment. D. Adjust the current year's assessment to compensate for the previous year's underpayment. Question 7. Quality control measures reveal that a broker-dealer registered in California has an associated person who also holds a significant ownership stake in a private equity fund that engages in lending activities. According to SEC Rule 17H1T, what is the most appropriate action for the broker-dealer's FinOp to take regarding record-keeping for this situation? Option A. Assume that only direct employees involved in sales require record-keeping under Rule 17H1T, and therefore no action is needed for this associated person's private equity fund involvement. Option B. Rely on informal verbal confirmations from the associated person about the financial health of their private equity fund and forego formal record collection, as this is sufficient for compliance. Option C. Systematically identify all associated persons and diligently collect and maintain records related to their financial activities outside the broker-dealer, as required by SEC Rule 17H1T, to assess potential risks. Option D. Focus solely on maintaining records pertaining to the broker-dealer's own operations and disregard the associated person's external financial activities, as Rule 17H1T is primarily concerned with the broker-dealer's direct business. Correct answer is C. Systematically identify all associated persons and diligently collect and maintain records related to their financial activities outside the broker-dealer, as required by SEC Rule 17H1T, to assess potential risks. Explanation. Scenario analysis. This scenario presents a professional challenge for a financial and operations principal FinUp at a broker-dealer registered in California. The challenge lies in interpreting and applying SEC Rule 17H1T, specifically concerning the record-keeping requirements for associated persons of brokers who are also involved in other financial activities. The FinUp must determine the scope of associated persons and the types of records that need to be maintained to ensure compliance with the rule, which aims to provide the SEC with a comprehensive view of potential risks arising from a broker-dealer's relationships with its associated persons and their other financial activities. Failure to correctly identify and maintain these records can lead to regulatory violations, fines, and reputational damage. Correct approach analysis. The best professional approach involves a thorough review of SEC Rule 17H1T and related guidance to ascertain the precise definition of associated person and the scope of financial activities that trigger record-keeping obligations. This includes understanding that the rule is designed to capture information about persons associated with the broker-dealer who are engaged in financial activities outside the broker-dealer itself, which could pose a risk to the broker-dealer. The FinUp should then establish a systematic process for identifying all such associated persons and diligently collecting and maintaining the required records, such as financial statements, information about material financial relationships, and any other information deemed necessary to assess the potential risk to the broker-dealer. This proactive and comprehensive approach ensures full compliance with the spirit and letter of the rule. Incorrect approaches analysis. One incorrect approach would be to narrowly interpret associated person to only include individuals directly employed by the broker-dealer in a sales capacity, thereby excluding individuals who may have significant financial interests or control over entities that engage in financial activities and are also associated with the broker-dealer in other capacities. This overlooks the broad intent of Rule 17H1T to encompass a wider range of relationships that could create risk. Another incorrect approach would be to assume that only records directly related to the broker-dealer's business need to be maintained, ignoring the requirement to gather information about the associated person's other financial activities. This fails to recognize that the rule's purpose is to assess risks stemming from these external activities. A further incorrect approach would be to rely solely on informal inquiries or verbal assurances from associated persons regarding their other financial activities without establishing a formal record-keeping system. This lacks the necessary documentation and audit trail required by regulatory bodies and leaves the broker-dealer vulnerable to accusations of noncompliance. Professional reasoning. Professionals facing this situation should adopt a decision-making framework that prioritizes regulatory compliance and risk management. This involves 1. Understanding the regulatory objective. Recognize that rules like 17H1T are designed to protect investors and the financial markets by providing regulators with visibility into potential risks. 2. Thoroughly researching the rule. Consult the exact text of SEC Rule 17H1T and any interpretive releases or no-action letters issued by the SEC. 3. Defining key terms. Clearly understand the definitions of associated person and financial activities as they apply to the specific rule. 4. Implementing robust internal controls. Develop and maintain clear policies and procedures for identifying, documenting, and retaining required records. 5. Seeking expert advice. If there is any ambiguity, consult with legal counsel or compliance experts specializing in SEC regulations. 6. Regular review and updates. Periodically review the process and records to ensure ongoing compliance as regulations and business relationships evolve. Question 8. Quality control measures reveal that a California-registered introducing broker-dealer, IBD, has been sharing office space and administrative support with an affiliated entity. The IBD's FinUp is reviewing the current arrangement for expense allocation. Which of the following approaches best ensures compliance with FINRA rules and California state regulations regarding affiliate transactions and expense sharing? Option A. Continue with the current informal arrangement, assuming that any expenses incurred by the affiliate that indirectly benefit the IBD are automatically legitimate shared costs. Option B. Operate under an informal understanding with the affiliate regarding expense sharing, without a formal written agreement or detailed record of the allocation basis. Option C. Establish a detailed written expense sharing agreement that clearly outlines the services provided by the affiliate, the methodology for allocating shared costs, and the basis for such allocations, with the IBD maintaining supporting documentation. Option D. Allocate expenses based on the affiliate's convenience and perceived benefit to the IBD, without a clearly defined or documented methodology. The correct answer is C. Establish a detailed written expense sharing agreement that clearly outlines the services provided by the affiliate, the methodology for allocating shared costs, and the basis for such allocations, with the IBD maintaining supporting documentation. Explanation. Scenario analysis. This scenario presents a common challenge for introducing broker-dealers (IBD) operating in California, particularly when dealing with affiliated entities. The core difficulty lies in ensuring that expense-sharing agreements are structured and documented in a manner that is both fair to the IBD and its customers, and compliant with FINRA rules and California state regulations. Mismanagement of these arrangements can lead to improper allocation of costs, potential violations of net capital requirements, and even customer harm if expenses are inflated or improperly passed through. The IBD's financial and operations principal, FINOP, must exercise meticulous judgment to uphold regulatory standards and ethical obligations. Correct approach analysis. The best professional practice involves establishing a written expense sharing agreement that clearly delineates the services provided by the affiliate, the methodology for allocating shared expenses, and the basis for the charges. This agreement must be reviewed and approved by the IBD's FINOP, ensuring that the allocation is fair and reasonable, and that the IBD is not subsidizing the affiliate or vice versa in a way that compromises its financial stability or customer protection. The agreement should also specify that the IBD will maintain adequate records to support the allocations, as required by FINRA Rule 17A3 and 17A4 in California Corporations Code Section 25245. This proactive and documented approach ensures transparency, accountability, and compliance. Incorrect approach is analysis. One incorrect approach is to operate under an informal understanding with the affiliate regarding expense sharing, without a formal written agreement. This lacks the necessary documentation and transparency required by regulators. It creates a significant risk of arbitrary expense allocation, potential for disputes, and difficulty in demonstrating compliance during an examination. This violates the principle of robust record keeping and clear contractual arrangements essential for regulatory oversight. Another incorrect approach is to allocate expenses based solely on the affiliate's convenience or perceived benefit, without a clear, objective methodology. This can lead to disproportionate charges to the IBD, potentially impacting its net capital and financial health. Such an approach fails to adhere to the fair and reasonable standard for expense allocations and can be viewed as an attempt to improperly shift costs, which is a direct violation of regulatory principles designed to protect broker-dealers and their customers. A third incorrect approach is to assume that any expenses incurred by the affiliate that indirectly benefit the IBD are automatically legitimate shared costs, without a detailed breakdown or justification. This can result in the IBD bearing costs that are not directly related to its operations or are improperly inflated. It bypasses the critical step of verifying the necessity and reasonableness of each allocated expense, leaving the IBD vulnerable to regulatory scrutiny and potential sanctions for non-compliance with expense allocation rules. Professional reasoning. Professionals should employ a decision-making framework that prioritizes clear, written agreements, objective allocation methodologies, and thorough record keeping when entering into expense sharing arrangements with affiliates. This framework should include 1. Due diligence, thoroughly understanding the services provided by the affiliate and their direct relevance to the IBD's business. 2. Contractual clarity, drafting a comprehensive written agreement that specifies services, allocation methods, and responsibilities. 3. Objective allocation, utilizing a consistent and defensible methodology for allocating shared costs. 4. Independent review, having the FINOP and potentially legal counsel review the agreement for fairness and compliance. 5. Ongoing monitoring, regularly reviewing expense allocations to ensure continued fairness and accuracy. Question 9. The assessment process reveals that an introducing broker-dealer registered in California has received a statement of claim initiating arbitration proceedings under the FINRA 13000 Series Code of Arbitration Procedure for industry disputes concerning an alleged trade error. Which of the following represents the most appropriate and professionally responsible course of action for the introducing broker-dealer? Option A. Immediately acknowledge receipt of the statement of claim and commence the formal process of preparing and filing a statement of answer and any necessary counterclaims within the prescribed FINRA timelines, while also cooperating with initial discovery requests. Option B. Attempt to contact the customer directly to negotiate a private settlement agreement, bypassing the formal arbitration process entirely. Option C. Instruct the compliance department to ignore the claim until FINRA contacts the firm regarding its status, assuming the customer may withdraw it. Option D. Delay filing a formal response to the statement of claim, citing ongoing internal investigations and the need for further documentation, without formally requesting an extension from FINRA. Correct answer is A. Immediately acknowledge receipt of the statement of claim and commence the formal process of preparing and filing a statement of answer and any necessary counterclaims within the prescribed FINRA timelines, while also cooperating with initial discovery requests. Explanation. Scenario analysis. This scenario presents a common challenge in the securities industry where an introducing broker-dealer, IBD, faces a dispute with a customer regarding a trade execution. The challenge lies in navigating the FINRA arbitration process, specifically under the 13000 Series Code of Arbitration Procedure for industry disputes, while ensuring compliance with regulatory obligations and maintaining professional integrity. The IBD must balance its duty to its client with the procedural requirements of arbitration, making careful judgment essential. Correct approach analysis. The best professional practice involves promptly acknowledging the arbitration claim and initiating the formal response process as outlined in the FINRA Code of Arbitration Procedure. This includes timely filing of the statement of answer and any counterclaims, as well as cooperating with the discovery process. This approach is correct because it directly adheres to the procedural mandates of the FINRA Code of Arbitration Procedure for industry disputes. By engaging proactively and formally, the IBD demonstrates respect for the arbitration process, fulfills its regulatory obligations to respond to claims, and positions itself to present a robust defense or resolution. This aligns with the ethical duty to conduct business with integrity and to resolve disputes fairly and efficiently. Incorrect approaches analysis. One incorrect approach is to ignore the arbitration claim, hoping it will be dismissed or resolved informally without formal engagement. This is professionally unacceptable because it violates the explicit procedural requirements of the FINRA Code of Arbitration Procedure for industry disputes. Ignoring a claim can lead to a default judgment against the IBD, significant financial penalties, and reputational damage. It also demonstrates a lack of integrity and a failure to uphold the firm's responsibilities in dispute resolution. Another incorrect approach is to attempt to resolve the dispute directly with the customer outside of the arbitration process, without consulting legal counsel or adhering to the procedural rules. While informal resolution can sometimes be beneficial, doing so unilaterally and without proper consideration of the arbitration rules can prejudice the IBD's position within the arbitration. It may also violate FINRA rules regarding communication with parties in arbitration, and could be seen as an attempt to circumvent the established dispute resolution mechanism, which is a failure of professional conduct and regulatory compliance. A further incorrect approach is to delay the response to the arbitration claim significantly, citing internal administrative issues. While administrative challenges can occur, the FINRA Code of Arbitration Procedure for industry disputes sets strict timelines for responses and filings. Excessive delays without proper justification and communication with FINRA can result in sanctions, including the dismissal of the IBD's defenses, or even the claim itself being decided against them. This demonstrates a lack of diligence and a failure to prioritize regulatory compliance and the orderly resolution of disputes. Professional reasoning. Professionals facing arbitration claims should adopt a proactive and compliant stance. The decision-making process should prioritize understanding the specific rules governing the dispute resolution process. In this case, the FINRA 13000 Series Code of Arbitration Procedure for industry disputes. This involves immediate acknowledgement of the claim, thorough review of its contents, consultation with legal counsel specializing in securities arbitration, and strict adherence to all procedural deadlines and requirements for filing responses and engaging in discovery. The focus should always be on fulfilling regulatory obligations and participating in the arbitration process in good faith to achieve a fair and timely resolution. Question 10. Governance review demonstrates that a U.S.-based introducing broker-dealer holds a significant position in a private placement security for which active market quotations are not readily available. The firm's financial and operations principal, FINOP, is tasked with determining the appropriate valuation for this security for the firm's net capital computation under SEC Rule 15c3-1. The security was purchased at $10 per share, and the firm has incurred minimal transaction costs. The FINOP has access to internal analyses suggesting a potential fair value range between $5 and $8 per share, based on comparable company valuations and projected future cash flows, but no recent arm's length transactions have occurred. Which of the following approaches best reflects the required regulatory and accounting treatment for valuing this security for net capital purposes? Option A. Value the security at the lower end of the estimated fair value range, $5 per share, applying the appropriate haircut for illiquid securities as prescribed by the net capital rule, and document the valuation methodology and assumptions thoroughly. Option B. Exclude the security from the net capital calculation entirely due to its illiquidity and lack of active market quotations. Option C. Value the security at its original purchase price of $10 per share, as this represents the firm's cost basis. Option D. Assign a nominal value of $0.01 per share to the security, as it is difficult to determine a precise market value. The correct answer is A. Value the security at the lower end of the estimated fair value range, $5 per share, applying the appropriate haircut for illiquid securities as prescribed by the net capital rule, and document the valuation methodology and assumptions thoroughly. Explanation. Scenario analysis. This scenario presents a common challenge for a financial and operations principal FINOP in a U.S.-based broker-dealer. The challenge lies in accurately valuing illiquid securities held in proprietary accounts for net capital computation purposes, especially when market quotations are not readily available. FINOP must adhere to strict SEC and FINRA regulations, as well as GAAP, to ensure the firm's financial statements and net capital calculations are accurate and compliant. Failure to do so can result in significant regulatory penalties, reputational damage, and potential financial instability for the firm. The decision-making process requires a thorough understanding of accounting principles, regulatory requirements, and the ability to exercise professional judgment in valuing assets. Correct approach analysis. The best professional practice involves valuing the illiquid securities using a reasonable methodology that reflects their fair value, as defined by GAAP, and is acceptable under SEC Rule 15c3-1. Net capital rule. This typically means employing a valuation technique that considers factors such as recent arm's length transactions, comparable securities, discounted cash flow analysis, or other recognized valuation models, documented thoroughly. The FINOP must then apply the appropriate haircuts or charges as prescribed by the net capital rule to these fair values. This approach is correct because it directly addresses the requirement to determine the market value of securities for net capital purposes, adhering to both GAAP fair value principles and the specific dictates of the net capital rule. The SEC's guidance and interpretations of Rule 15c3-1 emphasize the need for reasonable valuation methods when market quotations are unavailable. Incorrect approaches analysis. One incorrect approach would be to simply use the amortized cost of the securities. This is incorrect because amortized cost does not reflect the current market value, which is essential for net capital calculations. The net capital rule requires securities to be valued at their market value, and amortized cost is a historical cost measure that can significantly differ from fair value, especially for illiquid or distressed securities. This would lead to an inaccurate net capital computation and potential noncompliance. Another incorrect approach would be to ignore the securities entirely in the net capital calculation, assuming they have no value due to illiquidity. This is incorrect because even illiquid securities have a value, and the net capital rule requires that all securities be accounted for. Ignoring them would artificially inflate the firm's net capital, creating a false sense of financial security and violating regulatory requirements. A further incorrect approach would be to arbitrarily assign a nominal value, such as $0.001 per share, without any supporting methodology. This is incorrect because it lacks any basis in fair value or regulatory guidance. Such an arbitrary valuation is not a reasonable estimation of market value and would be considered a manipulation or misstatement of the firm's financial position, leading to severe regulatory consequences. Professional reasoning. Professionals should approach this situation by first identifying the relevant regulatory framework, SEC Rule 15C3-1, and applicable FINRA rules, and Accounting Standards GAAP, specifically ASC 820, fair value measurement. They should then gather all available information about the illiquid securities, including any internal analyses or external data that might inform their value. The next step is to select and apply a reasonable valuation methodology that aligns with GAAP and regulatory expectations for illiquid securities. This methodology must be thoroughly documented, including the assumptions and inputs used. Finally, the calculated fair value should be used to determine the appropriate net capital charges according to Rule 15C3-1. If there is significant uncertainty or complexity, consulting with external valuation experts or seeking guidance from regulators is advisable. Question 11. Governance review demonstrates that a registered broker-dealer in California needs to ensure its contact information filed with FINRA is current. Which of the following actions best upholds the firm's regulatory obligations regarding member filing and contact information requirements? Option A. Update contact information only when there is a substantial change in the firm's overall structure or key executive personnel. Option B. Wait for FINRA to contact the firm directly to request updated information before initiating any review or submission. Option C. Rely on FINRA automated system to send reminders for contact information updates and only update when these reminders are received. Option D. Implement an annual internal policy to review and update all required FINRA filing information, including contact details for principals and the firm, and ensure immediate updates are made upon any changes. The correct answer is D. Implement an annual internal policy to review and update all required FINRA filing information, including contact details for principals and the firm, and ensure immediate updates are made upon any changes. Explanation. Scenario analysis. This scenario presents a common challenge for registered individuals and firms, maintaining accurate and up-to-date contact information with the Financial Industry Regulatory Authority, FINRA, in the United States. The professional challenge lies in understanding the specific requirements for filing and updating this information, recognizing the potential consequences of noncompliance, and implementing a robust internal process to ensure accuracy. Failure to do so can lead to regulatory scrutiny, disciplinary actions, and a breakdown in communication between FINRA and the firm, impacting its ability to operate. Careful judgment is required to interpret FINRA rules and apply them diligently to the firm's operational reality. Correct approach analysis. The best professional practice involves proactively establishing and adhering to a clear internal policy for reviewing and updating all required FINRA filing information, including contact details for principals in the firm itself, at least annually and immediately upon any changes. This approach directly addresses the core of FINRA Rule 1122 and related guidance, which mandates accurate and timely filings. By conducting regular reviews and implementing immediate update procedures, the firm demonstrates a commitment to regulatory compliance and ensures that FINRA has the most current information to contact the firm and its designated principals. This proactive stance minimizes the risk of missed communications or regulatory violations. Incorrect approaches analysis. Relying solely on the FINRA system to send reminders for updates is a flawed approach. While FINRA may send notifications, it is the firm's ultimate responsibility to ensure the information is accurate and submitted in a timely manner, regardless of whether a reminder is received. This passive approach can lead to outdated information if the firm misses a notification, or if FINRA records are not current. Assuming that contact information only needs to be updated if there is a significant change in the firm's structure or personnel, such as a change in ownership or a new CEO, is also incorrect. FINRA rules require reporting of various changes, including but not limited to changes in business address, telephone number, and the designated principal's contact information. This narrow interpretation of significant change can result in many reportable events being overlooked, Waiting for FINRA to initiate contact or request specific information before reviewing and updating contact details represents a reactive and non-compliant strategy. This approach places the burden of identifying inaccuracies on the regulator rather than the firm. It significantly increases the risk of regulatory violations, potential fines, and reputational damage, as it indicates a lack of diligence in fulfilling ongoing reporting obligations. Professional reasoning. Professionals should adopt a proactive and systematic approach to regulatory compliance. This involves understanding the specific filing and contact information requirements mandated by FINRA for broker-dealers operating in the United States. A robust internal control system should be established that includes regular, scheduled reviews of all required filings, with specific attention to contact information for the firm and its principals. Furthermore, a clear procedure must be in place for immediate reporting of any changes to this information, as stipulated by FINRA rules. This systematic and diligent approach ensures ongoing compliance, facilitates effective communication with the regulator, and mitigates the risk of disciplinary action. Question 12. Process analysis reveals that a registered dealer in Ontario, Canada, is reviewing its balance sheet for the upcoming regulatory filing. The firm holds a significant portfolio of publicly traded securities intended for sale within the next 6 months, alongside a long-term investment in a private equity fund with no immediate redemption options. The firm also has accounts payable due within 30 days and a long-term loan with principal payments due in 3 years. As the financial and operations principal, what is the most appropriate method for categorizing these items to ensure compliance with Ontario Securities Commission (OSC) and Investment Industry Regulatory Organization of Canada (IIROC) requirements? Option A. Classify the publicly traded securities and the private equity investment as non-current assets, and the accounts payable and the long-term loan as non-current liabilities. Option B. Classify all assets as current assets, regardless of their intended holding period or liquidity, and all liabilities as current liabilities, irrespective of their maturity dates. Option C. Classify the publicly traded securities as current assets, but classify the private equity investment, accounts payable, and the long-term loan as non-current liabilities. Option D. Classify the publicly traded securities as current assets, the private equity investment as a non-current asset, the accounts payable as current liabilities, and the long-term loan as a non-current liability, based on their respective liquidity and maturity dates. Correct answer is D. Classify the publicly traded securities as current assets, the private equity investment as a non-current asset, the accounts payable as current liabilities, and the long-term loan as a non-current liability, based on their respective liquidity and maturity dates. Explanation. Scenario analysis. This scenario presents a common challenge for a financial and operations principal, FINRA, in Ontario, Canada, regarding the accurate classification of a firm's assets and liabilities. The challenge lies in distinguishing between assets that are readily convertible to cash and those that are not, and similarly, between liabilities that are due within a short time frame and those that are not. Misclassification can lead to an inaccurate picture of the firm's financial health, potentially impacting regulatory compliance, investor confidence, and the firm's ability to meet its obligations. The FINRA must exercise careful judgment to ensure adherence to the Ontario Securities Commission (OSC) regulations and the Investment Industry Regulatory Organization of Canada (IIROC) rules. Correct approach analysis. The best professional practice involves meticulously reviewing the terms and conditions of each asset and liability to determine its liquidity and maturity. For assets, this means assessing whether they can be converted to cash within 1 year, current assets, or if they are expected to be held for longer than 1 year, non-current assets. For liabilities, it involves determining if they are due within 1 year, current liabilities, or if they are payable beyond 1 year, non-current liabilities. This approach aligns with the principles of prudent financial management and regulatory reporting requirements in Ontario, which necessitate a clear distinction between short-term and long-term financial positions to assess solvency and liquidity. Specifically, this aligns with the requirements under Ontario securities law and IIROC rules for financial reporting and net capital calculations, which rely on accurate asset and liability categorization. Incorrect approach is analysis. Classifying all assets as current simply because they have some market value, regardless of their actual convertibility or holding period, is an incorrect approach. This fails to acknowledge the distinction between liquid and illiquid assets, potentially overstating the firm's immediate financial resources and violating the principles of accurate financial reporting under OSC and EROC guidelines. Categorizing liabilities based solely on the total amount owed without considering their due dates is also an incorrect approach. This ignores the critical distinction between short-term obligations that require immediate attention and long-term commitments. Such misclassification can lead to a failure to meet short-term obligations, potentially resulting in regulatory breaches and financial distress, contrary to the prudent financial management expected under Ontario securities law. Treating all assets as non-current and all liabilities as non-current, irrespective of their actual liquidity or maturity, is fundamentally flawed. This approach would obscure the firm's short-term financial position, making it impossible to assess its ability to meet immediate obligations and comply with net capital requirements mandated by EROC and the OSC. Professional reasoning. Professionals in Ontario, Canada, tasked with financial and operations oversight, must adopt a systematic and evidence-based approach to asset and liability categorization. This involves 1. Understanding the specific definitions of current and non-current assets and liabilities, as outlined in relevant accounting standards and regulatory pronouncements applicable in Ontario, e.g., OSC Rule 31-505, EROC Dealer Member Rules. 2. Thoroughly examining the underlying documentation for each asset and liability to ascertain its nature, liquidity, and maturity date. 3. Applying a consistent methodology for classification across all financial instruments and obligations. 4. Regularly reviewing and updating classifications as circumstances change. 5. Consulting with legal and accounting professionals when complex or ambiguous situations arise. This disciplined approach ensures accurate financial reporting, robust risk management, and compliance with regulatory obligations. Question 13. The control framework reveals that the internal audit department of a FINRA-registered broker-dealer located in California has identified a material discrepancy in the calculation of the firm's net capital, which is a key component of its annual SEC Rule 17a-5 focus report. What is the most appropriate immediate course of action for the internal audit department to take? Option A. Make an arbitrary adjustment to other financial line items within the report to offset the net capital discrepancy without understanding its cause. Option B. Immediately escalate the identified discrepancy to senior management and the firm's designated financial and operations principal, FINOP, for investigation and resolution. Option C. Proceed with filing the focus report as is, assuming the discrepancy is minor and unlikely to be detected by regulators. Option D. Continue to investigate the discrepancy internally for an extended period before informing senior management or the FINOP to avoid unnecessary alarm. Correct answer is B. Immediately escalate the identified discrepancy to senior management and the firm's designated financial and operations principal, FINOP, for investigation and resolution. Explanation. The control framework reveals a critical juncture for a FINRA-registered broker-dealer in California concerning its annual financial and operational condition report, known as the Focus Report, which is mandated by SEC Rule 17a-5. The professional challenge lies in ensuring the accuracy, completeness, and timely submission of this report, as it serves as a primary tool for regulators to assess the firm's financial health and operational compliance. Misstatements or omissions can lead to significant regulatory scrutiny, fines, and reputational damage. The firm's internal audit department has identified a discrepancy in the calculation of net capital, which directly impacts the focus report. The best professional approach involves immediately escalating the identified discrepancy to senior management and the firm's designated financial and operations principal, FINOP. This approach prioritizes transparency and adherence to regulatory requirements. By promptly informing key personnel, the firm can initiate a thorough investigation into the cause of the net capital miscalculation, determine the financial impact, and ensure that the focus report is amended or corrected prior to its official filing deadline, or if already filed, that an amendment is promptly submitted. This aligns with the ethical obligation to maintain accurate books and records and the regulatory mandate under SEC Rule 17a-5 to report financial and operational information truthfully and without material omission. An incorrect approach would be to overlook the discrepancy, assuming it is minor and unlikely to be detected by regulators. This failure to address a known issue directly violates the spirit and letter of SEC Rule 17a-5, which requires accurate reporting. It also demonstrates a disregard for the firm's internal controls and the FINRA responsibility for the firm's financial reporting. Another professionally unacceptable approach is to attempt to conceal the discrepancy by making an arbitrary adjustment to other financial figures to artificially balance the report without understanding the root cause. This constitutes a deliberate misrepresentation of the firm's financial condition, a serious ethical breach, and a violation of SEC Rule 17a-5. Such actions undermine the integrity of the financial markets and the regulatory oversight process. Finally, an incorrect approach would be to delay reporting the discrepancy to senior management and the FINRA, while the internal audit department attempts to resolve it independently without clear authority or established procedures for such situations. While internal investigation is necessary, withholding critical information that impacts a regulatory filing from the responsible principal and senior management creates a communication breakdown and delays the necessary corrective actions, potentially leading to a late or inaccurate filing. Professionals should adopt a decision-making framework that emphasizes proactive identification, transparent communication, and rigorous adherence to regulatory requirements. When a potential issue impacting a regulatory report is identified, the immediate steps should be to 1. Document the finding thoroughly. 2. Escalate the finding to the designated responsible principal, in this case, the FINRA and senior management. 3. Collaborate with relevant departments to investigate the root cause and quantify the impact. 4. Determine the appropriate corrective action, including potential amendments to filed reports. 5. Ensure timely and accurate submission of all required regulatory filings. Question 14. The assessment process reveals that a registered broker-dealer operating in California has discovered significant, unrecorded liabilities that materially impact its net capital. As the financial and operations principal, FINRA, responsible for the firm's financial reporting and compliance, what is the most appropriate immediate course of action to ensure adherence to California securities regulations and FINRA rules? Option A. Attempt to downplay the significance of the unrecorded liabilities to clients during routine communications without a formal internal review. Option B. Immediately inform the firm's compliance department and the designated FINRA of the discovered material adverse information regarding the firm's financial condition. Option C. Delay reporting the information until the next scheduled financial statement audit to avoid unnecessary alarm. Option D. Inform only the firm's senior management and await their directive on how to proceed. The correct answer is B. Immediately inform the firm's compliance department and the designated FINRA of the discovered material adverse information regarding the firm's financial condition. Explanation. Scenario analysis. This scenario presents a professional challenge for a FINRA in California because it involves a potential misrepresentation of the firm's financial condition to clients and regulators. The core issue is the timing and accuracy of disclosures, which are critical for maintaining investor confidence and regulatory compliance under California's specific securities laws and FINRA rules applicable to broker-dealers. A failure to provide timely and accurate financial information can lead to significant regulatory penalties, reputational damage, and loss of client trust. Correct approach analysis. The best professional practice involves immediately informing the firm's compliance department and the designated FINRA of the discovered material adverse information regarding the firm's financial condition. This approach is correct because it adheres to the principle of prompt and accurate disclosure mandated by FINRA Rule 17a-5 and California Corporations Code Section 25,245, which require broker-dealers to maintain accurate financial records and disclose material adverse information. By escalating the issue internally, the firm can then take appropriate steps to notify regulatory bodies, like the SEC and FINRA, and affected clients in a timely and compliant manner, as required by Rule 17a-5d, 1I, and Roman 2. This ensures transparency and allows for proactive management of the situation. Incorrect approaches analysis. One incorrect approach is to delay reporting the information until the next scheduled financial statement audit. This is professionally unacceptable because it violates the spirit and letter of disclosure requirements. Material adverse information, especially concerning financial stability, cannot be held back until a routine audit. California Corporations Code Section 25245 and FINRA Rule 17A5D. 1. Necessitate immediate action upon discovery of such information, not a deferral until a predetermined reporting cycle. This delay could be construed as an attempt to conceal the firm's true financial state, leading to severe regulatory sanctions. Another incorrect approach is to only inform the firm's senior management without involving the compliance department or the designated FINUP. While informing senior management is a step, bypassing the compliance function and the FINUP, who are specifically responsible for financial and operational oversight and regulatory reporting, is a critical failure. The FINUP has a direct regulatory responsibility under FINRA Rule 17A5 to ensure the accuracy of financial statements and disclosures. Failing to involve them directly in the initial discovery and reporting process undermines the internal control structure and regulatory compliance framework. A third incorrect approach is to attempt to downplay the significance of the information to clients without a formal internal review or regulatory consultation. This is highly problematic as it constitutes a potential misrepresentation. The firm's obligation is to disclose material adverse information accurately and promptly, not to manage client perception by minimizing the issue. Such an action could violate anti-fraud provisions under both federal securities laws and California's Corporate Securities Law of 1968, and would certainly breach ethical obligations of transparency and fair dealing. Professional reasoning. Professionals in this role must prioritize regulatory compliance and ethical conduct. When faced with potential material adverse financial information, the decision-making process should involve 1. Immediate internal reporting to the designated compliance personnel and the FINUP. 2. A thorough assessment of the information's materiality in consultation with legal and compliance. 3. Prompt adherence to all regulatory notification requirements, including those from FINRA and the SEC, and any applicable state securities regulators. 4. Transparent and accurate communication with affected clients. This structured approach ensures that all legal and ethical obligations are met, protecting both the firm and its clients. Question 15. In California, an introducing broker-dealer is seeking to expedite its client onboarding process to gain a competitive edge. The firm is considering implementing a new procedure where customers provide their identifying information, and the firm will only perform independent verification on a sample basis, or if specific red flags are immediately apparent, to reduce operational overhead. This approach is being considered in the context of the firm's obligations under the Securities Exchange Act of 1934. Which of the following best evaluates this proposed approach? Option A. This approach is the best practice because it balances regulatory compliance with operational efficiency, allowing the firm to onboard clients more quickly while still addressing potential risks. Option B. This approach is acceptable because the Securities Exchange Act of 1934 primarily focuses on market manipulation and insider trading, with less emphasis on the specifics of customer verification for IBDs. Option C. This approach is professionally unacceptable as it fails to meet the Securities Exchange Act of 1934 mandate for robust customer identification and verification procedures, increasing the risk of noncompliance and facilitating illicit activities. Option D. This approach is acceptable as long as the firm documents the rationale for selecting which accounts to verify and maintains a general policy of customer due diligence. The correct answer is C. This approach is professionally unacceptable as it fails to meet the Securities Exchange Act of 1934 mandate for robust customer identification and verification procedures, increasing the risk of noncompliance and facilitating illicit activities. Explanation. The scenario presents a common challenge for introducing broker-dealers, IBD, in California, balancing the need for efficient client onboarding with the stringent requirements of the Securities Exchange Act of 1934, particularly concerning customer identification and verification. The challenge lies in the potential for IBDs to streamline processes to attract business while ensuring compliance with anti-money laundering (AML) and customer due diligence (CDD) regulations, which are critical for preventing illicit financial activities and maintaining market integrity. Failure to implement robust procedures can lead to significant regulatory penalties, reputational damage, and even loss of registration. The best professional practice involves a proactive and comprehensive approach to customer identification and verification, directly addressing the requirements of the Securities Exchange Act of 1934 and related regulations. This approach prioritizes obtaining and verifying essential customer information at the outset of the relationship. Specifically, it entails collecting and verifying identity information such as name, date of birth, address, and identification numbers, like a social security number or taxpayer identification number, for all individuals, and for entities, collecting information about their legal status, ownership, and control. This verification process should utilize reliable, independent sources. This aligns with the spirit and letter of the law, which mandates that broker-dealers know their customers to prevent fraud and financial crime. An approach that delays or omits thorough verification of customer identity information, relying solely on self-attestation without independent corroboration, represents a significant regulatory failure. The Securities Exchange Act of 1934, through its implementing rules and the broader AML framework, requires broker-dealers to establish and maintain procedures for verifying the identity of their customers. This failure to verify directly contravenes the Know Your Customer principle and increases the risk of facilitating money laundering or other illicit activities, exposing the firm to severe penalties. Another professionally unacceptable approach is to rely on outdated or insufficient verification methods that do not adequately confirm the customer's identity. Instance, accepting a utility bill that is several years old or a driver's license that has expired would not constitute reasonable verification. The regulations require that verification be performed using reliable, independent sources, and that the information obtained be current and accurate. This laxity in verification processes undermines the effectiveness of AML and CDD programs, creating vulnerabilities that regulators actively seek to address. Finally, an approach that focuses solely on collecting information without establishing a process to document and retain the verification records is also deficient. The Securities Exchange Act of 1934 and associated regulations require broker-dealers to maintain records of the information collected and the methods used for verification. Without proper record-keeping, the firm cannot demonstrate compliance to regulators during an examination, nor can it effectively review and update customer information as required. This lack of documentation is a direct violation of record-keeping requirements. Professionals should adopt a decision-making framework that begins with a thorough understanding of the regulatory obligations under the Securities Exchange Act of 1934 and related AML/CDD rules. This involves implementing a robust, documented customer identification program, CIP, that specifies the types of identifying information to be collected, the verification procedures, and the record-keeping requirements. Regular training for staff on these procedures and periodic reviews of the CIP's effectiveness are essential to ensure ongoing compliance and mitigate risks. Question 16. Governance review demonstrates that a registered broker-dealer in Ontario, Canada, has observed a pattern of unusual trading activity by one of its senior traders in a company's stock shortly before significant public announcements by that company. The firm's internal compliance department has flagged these trades, but has not yet initiated a formal investigation. What is the most appropriate course of action for the firm to take in response to these flagged activities? Option A. Immediately initiate a thorough internal investigation into the flagged trading activity, review relevant communication records, and consult with legal counsel to determine potential regulatory implications and appropriate reporting obligations under Canadian securities law. Option B. Advise the senior trader to temporarily cease trading in that specific stock and monitor their activity going forward, assuming the issue will resolve itself without further action. Option C. Consider the trades as legitimate market activity, unless there is irrefutable proof of the trader possessing material non-public information at the exact moment of each trade. Option D. Rely on the fact that the trader has not been directly accused of insider trading by any regulatory body and continue to monitor the situation passively. The correct answer is A. Immediately initiate a thorough internal investigation into the flagged trading activity, review relevant communication records, and consult with legal counsel to determine potential regulatory implications and appropriate reporting obligations under Canadian securities law. Explanation. Governance review demonstrates a critical need to assess the firm's compliance with Section 5 of the Securities Exchange Act of 1934, specifically concerning liability to contemporaneous traders for insider trading. This scenario is professionally challenging because it requires a nuanced understanding of what constitutes insider trading and the specific circumstances under which a firm can be held liable for the actions of its associated persons, even if not directly involved in the trading. The firm must balance its duty to supervise with the rights of investors to a fair market. Careful judgment is required to distinguish between legitimate market activity and prohibited insider trading, and to implement policies that prevent such violations. The best professional practice involves a proactive and comprehensive approach to identifying and mitigating potential insider trading risks. This includes establishing robust internal controls and surveillance systems designed to detect suspicious trading patterns among employees and clients. Furthermore, it necessitates clear policies and regular training for all personnel on insider trading prohibitions and reporting obligations. When potential violations are identified, the firm must have a defined protocol for prompt investigation and, if warranted, reporting to the appropriate regulatory authorities. This approach aligns with the SEC's emphasis on effective compliance programs and the firm's affirmative duty to prevent and detect insider trading, thereby protecting both the firm and its clients from liability. An incorrect approach would be to rely solely on the absence of direct knowledge or participation by senior management in the trading activity. While direct involvement is a factor, firms have a supervisory responsibility to ensure their systems and employees are not facilitating or engaging in insider trading, ignoring suspicious activity, or failing to investigate red flags, because no one in management directly benefited from the trade, is a significant regulatory failure. It demonstrates a lack of diligence and a failure to implement adequate supervisory procedures, which can lead to firm liability under Section 20A of the Securities Exchange Act of 1934, controlling person liability, or other relevant provisions. Another incorrect approach is to assume that if an employee trades in a security that is not currently subject to a specific trading restriction or blackout period, then no insider trading has occurred. This overlooks the fundamental definition of insider trading, which involves trading on material, non-public information, regardless of whether formal trading restrictions are in place. The absence of a formal restriction does not grant a license to trade on privileged information. This approach fails to recognize the broader ethical and legal obligations to maintain market integrity. Finally, an incorrect approach would be to only address potential insider trading issues reactively, after a regulatory inquiry or a complaint has been filed. This demonstrates a failure to implement a preventative compliance culture. Proactive surveillance and investigation are crucial. Waiting for a problem to arise before taking action indicates a deficiency in the firm's compliance program and a disregard for the ongoing duty to monitor and supervise trading activities. Professionals should employ a decision-making framework that prioritizes a strong compliance culture. This involves understanding the firm's regulatory obligations, implementing comprehensive policies and procedures, providing regular and effective training, conducting diligent surveillance, and investigating all potential violations thoroughly and promptly. When faced with potential insider trading scenarios, professionals must err on the side of caution, conduct thorough due diligence, and consult with legal and compliance experts to ensure adherence to all applicable laws and regulations. Question 17. Governance review demonstrates that a registered broker-dealer in California has a complex organizational structure with numerous affiliated entities, some of which are not directly involved in securities transactions. The firm's chief compliance officer is tasked with ensuring compliance with SEC Rule 17H2T regarding risk assessment reporting. Which of the following approaches best ensures adherence to the rule's requirements for identifying and reporting on affiliated entities that could pose a material risk? Option A. Limit the assessment to affiliated entities that are themselves registered broker-dealers or are directly engaged in similar securities-related activities. Option B. Exclude affiliated entities from the reporting requirements based on a general assumption that their transactions with the broker-dealer are immaterial, without a specific analytical basis. Option C. Conduct a comprehensive review of all affiliated entities to identify those whose financial condition or transactions with the broker-dealer could pose a material risk, and establish procedures to gather necessary data for accurate Form 17-1H reporting. Option D. Rely on the affiliated entity's self-assessments of their financial condition and risk exposure without independent verification by the broker-dealer. The correct answer is C. Conduct a comprehensive review of all affiliated entities to identify those whose financial condition or transactions with the broker-dealer could pose a material risk, and establish procedures to gather necessary data for accurate Form 17-1H reporting. Explanation. This scenario is professionally challenging because it requires a principal to interpret and apply complex reporting requirements under Rule 17H2T of the Securities Exchange Act of 1934, specifically concerning the identification and assessment of material risks posed by affiliated entities. The principal must balance the firm's operational efficiency with its regulatory obligations to provide accurate and timely information to the Securities and Exchange Commission, SEC. Misinterpretation or incomplete reporting can lead to significant regulatory scrutiny, fines, and reputational damage. The best approach involves a thorough review of the firm's organizational structure and the nature of its relationships with all affiliated entities, regardless of their direct involvement in registered broker-dealer activities. This includes identifying entities that, due to their financial condition or the nature of their transactions with the broker-dealer, could pose a material risk. The principal must then ensure that the firm has established robust internal controls and procedures to gather the necessary financial and operational data from these identified affiliates to accurately complete the Form 17-1H filing. This proactive and comprehensive assessment aligns directly with the intent of Rule 17H2T, which is to provide the SEC with a consolidated view of the risks associated with a broker-dealer's broader group of affiliated entities. This approach ensures compliance by addressing the spirit and letter of the regulation, focusing on risk identification and reporting as mandated by the SEC. An incorrect approach would be to limit the assessment only to those affiliated entities that are themselves registered broker-dealers or are directly engaged in activities that mirror the broker-dealer's core business. This fails to recognize that Rule 17H2T requires reporting on affiliates whose financial condition or transactions could pose a material risk, irrespective of their specific business lines. The regulatory failure here is an incomplete identification of reportable entities, leading to a potentially inaccurate and misleading filing. Another incorrect approach is to rely solely on the affiliate's own representations of their financial health without independent verification or a structured risk assessment process by the broker-dealer. While affiliates may provide information, the responsibility for the accuracy and completeness of the Form 17-1H filing rests with the broker-dealer. This approach risks overlooking undisclosed risks or misrepresentations, violating the duty to conduct due diligence and ensure the integrity of the reported information. Finally, an incorrect approach would be to exclude affiliated entities based on the assumption that their transactions with the broker-dealer are immaterial without a documented analysis to support this conclusion. The rule requires a risk-based assessment, and a blanket assumption of immateriality without a systematic review is a failure to adhere to the required analytical process. This can lead to the omission of significant risk factors from the filing, undermining the purpose of the rule. Professionals should adopt a systematic and risk-based approach to compliance. This involves understanding the specific requirements of the relevant regulations, in this case, SEC Rule 17H2T, identifying all potentially relevant entities, conducting a thorough risk assessment based on the nature of their relationships and transactions with the broker-dealer, and establishing clear internal controls to ensure accurate and timely reporting. When in doubt, consulting with legal counsel or compliance experts specializing in SEC regulations is advisable. Question 18. The efficiency study reveals a pattern of minor, recurring discrepancies during the monthly reconciliation of the firm's proprietary trading account with its general ledger. As the financial and operations principal for a New York-based broker-dealer, what is the most appropriate course of action to ensure compliance with FINRA financial and operational requirements? Option A. Manually adjust the general ledger to match the proprietary trading account for each identified discrepancy. Option B. Initiate a thorough investigation to identify the root cause of the recurring discrepancies and implement corrective actions to prevent future occurrences. Option C. Defer the investigation and correction of these discrepancies until the next scheduled internal audit. Option D. Document the discrepancies as immaterial and continue with the current reconciliation process. The correct answer is B. Initiate a thorough investigation to identify the root cause of the recurring discrepancies and implement corrective actions to prevent future occurrences. Explanation. The efficiency study reveals a recurring pattern of minor discrepancies in the reconciliation of the firm's proprietary trading account with its general ledger within the New York State regulatory framework. This scenario is professionally challenging because, while the individual discrepancies are small, their consistent appearance suggests a potential breakdown in internal controls or a systemic issue that could escalate into more significant financial misstatements. The FINRA rules, specifically those governing financial and operational requirements for broker-dealers, mandate accurate record-keeping and timely reconciliation to ensure the firm's financial health and protect investors. A financial and operations principal, FINOP, has a fiduciary duty to ensure these processes are robust and that financial statements accurately reflect the firm's position. The best professional practice involves a proactive and thorough investigation into the root cause of these recurring discrepancies. This includes not only identifying the specific accounts or transactions involved, but also understanding the underlying process failures. Implementing corrective action, such as enhancing reconciliation procedures, providing additional training to staff, or upgrading reconciliation software, is crucial. This approach aligns with FINRA Rule 17A3 and 17A4, which require accurate and current books and records, and FINRA Rule 2261, which mandates fair and accurate communication of financial information. By addressing the root cause, the FINOP ensures the integrity of the firm's financial reporting and compliance with regulatory obligations, an approach that focuses solely on correcting the individual discrepancies without investigating the underlying cause is professionally unacceptable. This superficial fix fails to address the systemic weakness, leaving the firm vulnerable to future, potentially larger, errors. It also violates the spirit of regulatory requirements that demand robust internal controls and accurate financial reporting, not just cosmetic adjustments. Another professionally unacceptable approach is to dismiss the discrepancies as immaterial due to their small size. Regulatory bodies like FINRA do not permit the arbitrary determination of materiality when it comes to financial records. Consistent errors, regardless of their individual value, can indicate a larger problem that could have significant implications for the firm's financial stability and its ability to meet its obligations to customers. This approach demonstrates a lack of diligence and a disregard for the comprehensive nature of financial record-keeping requirements. Finally, an approach that involves delaying the investigation and correction of these discrepancies until a formal audit or examination is initiated is also professionally unsound. Regulatory compliance is an ongoing responsibility, not a reactive one. Waiting for external pressure to address internal control weaknesses is a failure of the FINOP oversight duties and increases the risk of regulatory sanctions and reputational damage. Professionals should employ a decision-making framework that prioritizes proactive identification and resolution of financial control issues. This involves establishing clear reconciliation procedures, regularly reviewing reconciliation reports for anomalies, investigating any discrepancies promptly, and implementing sustainable corrective actions. The focus should always be on maintaining the accuracy and integrity of financial records in accordance with all applicable regulations. Question 19. During the evaluation of a routine FINRA audit in New York, your firm receives a request for specific trading data and client communication records related to a particular security that has experienced unusual price volatility. Which of the following represents the most appropriate initial response from your firm? Option A. Inform FINRA that the request is overly broad and requires significant internal resources, and propose a much later deadline for submission. Option B. Provide the most readily available trading data and a selection of client communications that appear relevant, assuming FINRA will follow up if more is needed. Option C. Allow individual registered representatives who handled accounts related to the security to directly communicate with the FINRA examiner to provide context and answer questions. Option D. Immediately acknowledge receipt of the request. Assemble a cross-functional internal team to gather and review all requested information, and ensure all communications with FINRA are managed through the compliance department. Correct answer is D. Immediately acknowledge receipt of the request. Assemble a cross-functional internal team to gather and review all requested information, and ensure all communications with FINRA are managed through the Compliance Department. Explanation. During the evaluation of regulatory inquiries, such as those stemming from audits or significant market movements, a firm's response is critically important. The professional challenge lies in balancing the need for prompt and accurate information with the firm's operational capacity and the potential implications of the information disclosed. Mismanagement of such inquiries can lead to severe regulatory sanctions, reputational damage, and loss of client trust. The most appropriate response involves a systematic and transparent process. This includes immediately acknowledging receipt of the inquiry, assembling a dedicated internal team with relevant expertise, legal, compliance, operations, and conducting a thorough internal investigation to gather all necessary information. Crucially, all communications with the regulator must be channeled through the designated compliance or legal department to ensure accuracy, consistency, and adherence to regulatory requirements. This approach prioritizes accuracy, regulatory compliance, and controlled communication, minimizing the risk of inadvertent misstatements or omissions. This aligns with FINRA Rule 3110, supervision, and the general principles of cooperation with regulatory bodies. An incorrect approach would be to provide a superficial or incomplete response, perhaps by only addressing the most obvious aspects of the inquiry without a comprehensive internal review. This fails to meet the regulatory expectation of thoroughness and can be interpreted as an attempt to conceal information or a lack of diligence, potentially violating FINRA Rule 3110 and the duty of good faith and fair dealing. Another inappropriate response is to delay the investigation and response significantly, citing operational burdens without proactively seeking extensions or communicating the challenges to the regulator. This can be seen as a lack of cooperation and may lead to regulatory action for failure to respond in a timely manner, contravening the spirit of FINRA Rule 3110, which emphasizes prompt attention to regulatory requests. Finally, attempting to provide information without proper internal vetting, or by allowing individual employees to communicate directly with the regulator without oversight, is highly problematic. This increases the risk of inconsistent or inaccurate information being provided, potentially leading to misunderstandings and regulatory scrutiny. It bypasses established compliance procedures designed to ensure accurate and authorized communication, which is a fundamental aspect of regulatory compliance. Professionals should adopt a decision-making framework that emphasizes proactive engagement, thoroughness, and controlled communication when faced with regulatory inquiries. This involves establishing clear internal protocols for handling such matters, ensuring adequate resources are allocated, and maintaining open lines of communication with the regulatory body through authorized channels. Question 20. What factors determine the appropriate course of action for a FINIP in New York when a broker-dealer's electronic books and records become temporarily non-current due to a system malfunction, and the firm is approaching a focus report filing deadline? Option A. Immediately work to restore the electronic records to a current and accurate state, and then proceed with filing the focus report electronically with the corrected data, ensuring all deadlines are met. Option B. Delay the electronic filing of the focus report until the system malfunction is fully resolved and all historical data is perfectly reconciled, even if it means missing the filing deadline. Option C. Manually reconstruct the missing or corrupted data from disparate sources without a clear plan for electronic integration and validation before the filing deadline. Option D. File the focus report electronically with the known data discrepancy, intending to amend it once the system issue is resolved. The correct answer is A. Immediately work to restore the electronic records to a current and accurate state, and then proceed with filing the focus report electronically with the corrected data, ensuring all deadlines are met. Explanation. This scenario is professionally challenging because it requires a financial and operations principle, FINIP, to balance the immediate need for accurate financial record keeping with the practicalities of data management and regulatory compliance under the Securities Exchange Act of 1934 and relevant SEC rules, specifically concerning electronic record keeping and timely filings. The FINIP must ensure that the firm's books and records are not only maintained, but are also current and readily accessible, even when dealing with potential data integrity issues or system outages. The core challenge lies in the potential for even a brief period of non-current records to constitute a violation, necessitating swift and compliant action. The best professional practice involves immediately addressing the discrepancy by restoring the records to a current state, and then promptly filing the required electronic reports, ensuring all data is accurate and complete. This approach prioritizes regulatory compliance by rectifying the issue at its root, and then fulfilling the reporting obligations. Specifically, under SEC Rule 17A4, which governs the preservation and accessibility of broker-dealer records, and FINRA Rule 4511, which mandates that broker-dealers keep current and accurate books and records, the firm must ensure its records are up to date. The electronic filing requirement, often through systems like the Focus Report, Financial and Operational Combined Uniform Single Report, necessitates timely and accurate submission. Therefore, the immediate restoration of records and subsequent accurate filing is the only compliant path. An incorrect approach would be to delay the electronic filing until the data discrepancy is fully resolved, even if the underlying records are being worked on. This fails to acknowledge the current requirement for books and records and the potential for the delay itself to be a violation. Furthermore, it risks missing the filing deadline, which carries its own set of penalties. Another incorrect approach is to file the electronic report with the known discrepancy, assuming it will be corrected later. This constitutes filing inaccurate information, a direct violation of reporting requirements, and a breach of professional integrity. Finally, attempting to manually reconstruct records without a clear plan for electronic submission and validation would be inefficient and could lead to further errors, delaying compliance and potentially misrepresenting the firm's financial position. Professionals should employ a decision-making framework that prioritizes regulatory adherence. This involves understanding the specific requirements of relevant rules, e.g., SEC Rule 17A4, FINRA Rule 4511, assessing the impact of any discrepancies on the accuracy and currency of records, and implementing immediate corrective actions. When electronic filings are involved, the process must include verification of data integrity before submission and adherence to filing deadlines. If a system issue causes records to be non-current, the immediate priority is to restore them, followed by accurate and timely filing.